Welcome, folks. Welcome. Sorry about that. Let's get started. I'm running a minute behind already, so don't want to waste too much time. A couple of things. One is a week from today, you have your mini break, because usually this would be a spring break week. So next Wednesday, you don't have classes. But there's no rest for the wicked. So when you come back on Monday, the following Monday, not this Monday, but the following Monday, you have your second quiz. So things will start to pile up. So I just wanted to give you advance notice of both that you have no class on Wednesday and that you have a quiz on Monday when you get back. So any questions before we start? Okay, so let's start. In fact, I'm going to start by picking on Neil because he sent me an email and I want to use that as the basis for talking a little bit about stories and value. So Neil, you want to unmute yourself? Is it okay if I bring up this? Because it's not for your projects. If it's secret and you don't want the rest of your group to know that you're working on another company on the side, I won't talk about it.
Not today, but go for it.
Yeah. Not today as in you don't want to talk about it today?
No, it's not a secret, and I'm not working for another company.
Okay. So basically, Neil's valuing Apple on the side. It's not his group project, but he wants to value Apple. And Neil, do you want to tell the class what the question was? Because I think it's a very good question in terms of thinking about valuation. What was the question you had?
So I was valuing Apple, and the question was the value I came up with was a lot lower than the current price, which is fine. But Apple is one of those companies that does not release information early on and make big claims. They kind of surprise its audience in September when they hold their major event.
Right.
And my question was, how do I incorporate those things in my DCF that they're going to come up with an Apple car or a cryptocurrency or something weird like that?
So does everybody get Neil's question, which is we know that Apple makes these bunched up surprise announcements where they tell the world what they're going to do, and it could be a surprise that, and the surprise almost certainly will change your revenues, your earnings, your cash flows. And I think the question is, without knowing the specifics of what they're going to announce, how do I put a value for Apple today? First, you're not alone, right? Every investor faces exactly the same challenge. So that's the first recognition. Nobody here has inside information. In fact, everybody's going on rumors. I mean, I get the Mac rumors email every day, and 3/4 of the rumors are false, but you get the rumors anyway. Now, the second is you got to step back. Where does Apple derive almost all of its value as a company now? 75% of Apple's value comes from one product. What's that product?
iPhone.
The iPhone, right? Everything else has become a side story. The Apple Watch, the Apple iPad, everything else is a side story. 75% comes from the iPhone, which means Apple's value rides from iPhone to iPhone, which means the iPhone 13, I don't know when it's coming out, like middle of next year. So we know Apple's value rests on how that, but it doesn't rest on the details of the iPhone 13. It's not what the iPhone 13 will be priced at and what it will cost, because those are things Apple control. You know what Apple doesn't control? It's whether its control of this franchise is going to weaken if people move away from the iPhone. The big question you're facing is not the fact that you don't know the details. The question about, will the iPhone franchise continue to deliver these incredible earnings and cash flows they have for the last 10 years? That's not going to be resolved in September. It won't even be resolved when the iPhone 13 comes out, but you're making your best guess. So that's a reality. That reality is not going to go away, even if I gave you a chance to move forward in time. In a time machine, I'll wager that if I put you in a time machine, took you to the September meeting, and you were able to listen in on what Apple said at the September meeting, and you came back to today, it'll have no effect on your valuation. So what I'm trying to say is, don't get focused on things you don't know that could happen. And two, don't overestimate how much those things can alter the trajectory for a company the size of Apple. This is a company where the bulk of the story comes from the iPhone now. And if they announce an Apple car, at the margin, by itself, that announcement is going to have a muted effect because there's so much work to be done, right? Because we still don't know what the car will look like, how much it'll have to spend, how it gets into the business. So all those things are out there, but I think they've been out there for 6 years. You know how many times I've heard rumors of the Apple car? Every year there's a rumor of the Apple car, or the Apple this, the Apple that. So we'll see how it plays out. But when you value Apple and you're getting a value much lower than today's price, it's not because you don't know what they're going to announce. It's because the market might have a much better or a much more optimistic view of how its existing products will put. I mean, one of the good news stories for Apple has been how the Apple services business has done the last 3 years, right? The Apple services business is, of course, everything that flows through the App Store is part of the services business. And it's a very lucrative business. But it's also a business where Apple, of all of its different things, it's a business that Apple is most exposed. And you saw this play out. Remember that Fortnite and App Store fight that happened? This was a few months ago when Apple forced Fortnite, the game, to be removed. And Fortnite sued, saying this is monopoly power. They're stopping us from marketing our product the way we want to, forcing. That's a very real risk that Apple runs, is they push this too hard, they could upend. So that, for me, is a worry. That's got nothing to do with what happened in September. To me, that's one worry. The other, of course, and the long-standing worry is, where will the iPhone franchise start to stagger? So far, it hasn't. But with each new introduction, you're kind of having less incremental advantages over the previous version, and you're pushing up the price. And you worry about, will this be the version that pushes customers too far? I don't know, but that's my uncertainty, and that uncertainty has nothing to do with September. So let's start with the test for today. We talked about storytelling, so I'm going to pick on a story, and I'm going to pick Ankit. You're going to be the person on the spot. So I'm an analyst. I've done a valuation of a company. I've come up with a compounded annual growth rate in revenues of 50% a year, an operating margin of 20% in year 10, which is twice the industry average. I have very low reinvestment given the growth, so net capex, acquisitions, et cetera, and a cost to capital of 7%, again below the market average. So 50% growth rate, 20% margins, low reinvestment, low cost to capital. So I'm going to ask you, because all you see is my Excel spreadsheet, right? I want you to convert the spreadsheet into a story. So what's the story I'm telling you about the company's size? 50% compounded annual growth rate in revenues over the next 10 years. That's going to make my small revenues too big. So I'm telling you a story about a company that's going after a big market. Okay. What am I telling you about the market itself? It must be growing. Otherwise, how could you get this growth? Because otherwise you'll be fighting for market share. I'm also telling you something about competition, right? By giving them a margin of 20% when the margins are 10%, I'm saying they're very strong competitive advantages. And I'm also telling you this is a capital light business. Now, I could be right about all of them, but that's what I'm trying to tell you is, when you start to argue with somebody about a discounted cash flow valuation, don't get dragged into, should I use 50% growth rate or 45% growth rate? That's not how you win. You push them on their core assumptions, a story that allows them to use this. This is an incredibly upbeat story about a growing company with amazing competitive advantages, very little capital intensity. And somehow all of these things happen very safely. Could that happen? Yes. In fact, we know the companies where this happens tend to be the trillion-dollar companies, right? You look at the FANG stocks, you basically get them. So when you look at a DCF, there's always a story. In fact, by giving you the cost of capital, I'm also telling you this is probably a non-discretionary product. That's what the low beta tells you. So behind every number is a story. So you told a story about a company, and I'm trying to get you all to tell your story. So let's say you tell your story, you convert into a DCF. I want to ask you a question about what might cause the story to change. So let's say 2 days after you send me your DCF, a new earnings report comes out about a company. Could that change the story for your company? Absolutely. Think of why. It's not that the per share earnings were higher or lower than expected. Who cares? It's something that the company tells you that they did last quarter that you never thought they would do. What if GameStop comes out with an earnings report in a couple of weeks that says that 60% of their revenues in the first quarter came from online retail? That would change my story for GameStop almost instantaneously. The price is going to shoot up. Or that they have a subscription model they've created for people who used to be GameStoppers, who that subscription model, they collect 10. I mean, those are things you look for in an earnings report. Today, I think the Federal Open Market Committee is meeting, and for better or worse, it might have an effect on rates. Could that affect your story? Absolutely, especially if you're a company very heavily dependent on rates staying low or rates going up, your story can be affected. You can see where I'm going, right? Everything that happens around you could affect your story. There's a regulatory change, could affect your story. Even your competitors reporting earnings report affects your story. If GM comes out with an earnings report saying, electric car sales are soaring, this sounds contradictory. Tesla will go up. Why? Because they're dependent on people switching away from traditional cars. So earnings reports from everything affects your story, which is a little bit of bad news, because what it means is you're never quite going to be done. Right? Your story is, and you shouldn't expect May 10th when you turn in your valuation, you're telling me your story about the company as of then. It'd be extraordinarily unfair of me to come back to you 5 years later and say, hey, you know what? Why didn't your story reflect? Now, I remember valuing Amazon in early 2000, in 2012 or somewhere, and I showed them my valuation from 2001, which I will show you too. And somebody asked me, well, how come you didn't build in the cloud business into your revenues? And I said, the only clouds I thought about in 2001 were the ones in the sky. If I'd known there was a cloud business coming, I would have built it in. So you can't bring in the benefits of hindsight in you. And finally, Sergio, you can help me out here. We talked about corporate life cycles. Remember, you said companies are young, they're startups, they're toddlers, then teenagers, the young and peak of their lives, they get middle-aged, they get old, and then they die. And we talked about stories and numbers, right? And when you tell stories, they connect to numbers. So the question I have is about every company, you use a mix of stories and numbers. Stories based on what you learned from the company, numbers based on looking at the financials, looking at the margin, looking at growth. Okay. Will that mix change, you think, as you go through the life cycle? So help me out here. Young companies, what are you most dependent on?
Revenues, growth.
And that comes from almost entirely a story, right? I have no financials. Think about the Uber valuation that I was in the middle of. I had absolutely no financial statements. You know what? Even if I did, what difference would it have made? All I've learned is they weren't making much revenue and they were losing a lot of money. With young companies, it's almost all storytelling. And the storytelling ultimately plays out as revenue growth margins, but it's not based on looking at the numbers for the company. In contrast, if you're looking at Coca-Cola, numbers play a much bigger role, right? I mean, the analogy I would offer is when your value, how, these famous authors and they write books and then suddenly let's say they pass away and the publisher wants to complete the book. I remember the dragon tattoo, remember that series, the girl with the dragon tattoo. I think after 2 books, the person was writing the 3rd book and then kicked the bucket. And the publisher then went and found somebody else to finish the story. So let's play a game. Let's assume that you're an aspiring writer. And let's make this morbid. Let's assume that I hire you, as I'm a publisher, I hire you. I hired you to finish the book that somebody else started but has died in the middle of. But they died in chapter 1. And it's a 30-chapter book. This is your story to tell, right? Chapter 1, the characters are still unformed. You can make new characters come on. You can give the book any form you want. You can take it in any direction you want. In contrast, if I called you and said, look, I'm in chapter 28 of this book. There are only 2 more chapters to finish. Can you finish those chapters? You're now much more constrained because you can't create things that are in contradiction with what you've already learned. You see where I'm going? When I ask you to value Uber, the future is right there in front of you. You can come up with different stories, and I can't prove you wrong. If you take Coca-Cola and you make it a technology and a software company and say this doesn't work, it's completely contradictory to what we know about the company. The question I often get asked, especially about the storytelling part, is how did we get away in valuation without ever telling stories? Because you look at every valuation book, including mine, the 80s, the 90s. You know why? Because the companies we used to value in these books tended to be mature, boring companies. We could get away doing financial ratio analysis and forecasting and call that valuation. That's not going to work if you're valuing Roblox or Airbnb, because you're in chapter 1. Reading what's already been written about the company is going to tell you very little. Everything lies in the future. So let's turn back to where we were in my Uber storytelling. I talked about the danger of runaway stories and how if you let a charismatic storyteller lead you down the garden path, you can very quickly start to believe the story. You want it to be true. And if that storyteller then develops feet of clay, their weaknesses come out, the whole story comes apart. And I used the WeWork example to kind of illustrate what happens when you stop trusting the storyteller. So now let's talk about a couple more cases where you can get yourself into trouble even though you think you're acting rationally. So let's play a game. Let's assume you're looking at a big market. Like what? Artificial intelligence. China always works, China. Electric cars. And you're an entrepreneur. Let me ask you a question. If any of you know entrepreneurs, founders of companies, do they tend to be overconfident people or do they tend to be diffident people? What's the essence of being an entrepreneur? You think you can pull this off. You tend to be confident. Hold on to that thought. So you're an overconfident entrepreneur looking at a big market. So what do you think? I can start a business to take advantage of the market. Of course, you don't have capital. You approach venture capitalists. Venture capitalists, do they tend to be diffident kind of people who stay in the background, or do they tend to be overconfident people? I mean, think Mark Cuban. He's kind of a very shy person, right? He doesn't say what's on his mind. Venture capitalists are really they think they can pick winners. So let's say you find 3 venture capitalists who believe in your concept. They think they found the right winner. So you've created a little cluster, right? You're a founder, you created a company to take advantage of the big market. You have 3 VCs, all think you are going to succeed, and they're all overconfident, and you go after the big market. Now wait, this is a big market. There were 20 other clusters just like yours, founding all over Silicon Valley, all looking at the same market, all playing this game centered around an overconfident founder and overconfident VCs. So with each cluster, if I went and said, what's the value attached to your company? What are they going to tell you? They feel they're going to be the winners. They project out their share of this big market, and they say, you know what, we're going to win. But here's the problem. If I take all 20 of your clusters or all 100 of your clusters and I add up what you're projecting as revenues for your company, you know what I'm going to find? I'm going to find collectively you're projecting far more revenues than this market can ever deliver. I call this the big market delusion. I wrote about this in the context of online advertising, where every social media company that came in, people said, no. But you can think about the electric car market, right? Nikola, Neo, basically everybody, what are they selling? Big market. Eventually, will there be a reckoning? Absolutely. But eventually can take a while. It can take 5, 7. It took the dot-com companies almost 5 years before the reckoning came. And the reckoning basically meant that you shook out this group. Now you're saying, should I just sell short than every electric car company? Not unless you want to risk your life. I'm not saying every electric car company is overvalued. I'm just saying collectively they're overvalued. But when you see artificial intelligence companies, electric car companies, now with Roblox, the gaming social media companies, I'm not saying the story doesn't make sense. I'm just saying the collection of stories I'm hearing from every player using the same story doesn't make sense. In fact, what I did for the online advertising market is I reversed out from the market price what the revenues would have to be 10 years from now. So basically, I kept took the cash flows. Instead of doing a valuation, I said, what would the revenues need to be 10 years from now to justify what I'm paying? And when I did this in 2016 for online advertising companies, I came up with revenues that were twice as large as the entire market. That's a big market delusion. And one final example, and we'll let this go. You talk about stories driving value. For the last decade, we've had the ultimate story company, Tesla. You know what makes Tesla such a fascinating story company? You don't even know what story you're telling, right? You first started off, you said they're a luxury car maker. Okay, you start with that story. Then Elon Musk, of course, throws a wrench. He says, no, we're in the electric business. We're a battery company. So basically, it's a story that keeps shifting on you. And of course, with Elon Musk at the helm, who knows where the story is going? It could be a boring company for all, not boring as in the traditional boring. You know what boring I'm talking about? Is the other business Elon Musk is in. He's actually boring under cities to create an alternate transportation system. It's a shifting story company. So in 2013, this is very early in Tesla's life. That's the first time I value Tesla. I value Tesla, and I've been valuing every year since. And with Tesla, you're always, there are people in either extreme. People who think it's worth nothing, and people who's worth. And I tried to kind of, thread the needle and get heard from both sides. In 2013, I'd valued Tesla on my blog, and I came up with a $160 value per share, which I thought was incredibly generous for a company at that time which was selling 24,000 cars. So I put out the valuation. Then a couple of days later, somebody sends me an equity research report from a major investment bank, from a Tesla analyst. One of the things about Tesla analysts is, remember the Stockholm syndrome I talked about when I talked about analysts? Tesla analysts are particularly susceptible to this. And this analyst was the biggest promoter of Tesla I'd ever seen. Everything he wrote about Tesla is great. And he put out a valuation of Tesla, which was 4 times higher than mine. So I'm curious, what is he assuming about the future that's giving him such a high value? So I open up his equity research report, runs like 200 pages. And already I should have stopped. 200 pages tell me how much a company is worth, but he's telling stories, he had pictures. And then on page 55, he had a D.C.F. That's what he called it. So I'm going to stay with this terminology. So I said, okay, this is where I live. Let's see what he's assuming. So open it up, and here's what he said. His DCF says that Tesla, the number of cars they will sell, will increase from 24,000, which is where they were at the time of the valuation, to 1.1 million. Let me pause right there. Is that plausible? 1.1 million cars. Absolutely. There were 80 million cars sold last year. 1.1 million is not a big deal. So I said, okay, you're optimistic about the surge in sales, but I can live with that. Along the way, so when I looked at that, the one thing that puzzled me was he was actually predicting slightly fewer cars being sold than I was projecting in my valuation. I said, so why is he getting 4 times the value? So I look at his margins, expecting to see tech company margins, because one of the stories you can tell about Tesla is it's really a software company masquerading as a car company. It can get margins like Microsoft. But he was estimating margins about what I was estimating. In fact, he was estimating margins lower than mine for the company. Now I'm completely befuddled. His revenue, the number of cars and revenues he's projecting are close to mine. His margins are close to mine. So why is his value? So I go and take a look at 2 numbers. And this is a suggestion I'll make on DCFs. I looked at his after-tax operating income, which is kind of he called it net income, but it's kind of a version of after-tax operating income, and his unlevered cash flow. So basically, he's giving you his after-tax operating income and his free cash flow to the firm. I added up his income for the next 15 years. And I added up his free cash flows for the next 15 years, and I took the difference. You know what I was trying to figure out, right? How much of your earnings are you putting back into the business? How much are you reinvesting? And over the next 15 years, so don't get caught up in CapEx separately because it's a net effect that matters. Over the next 15 years, he was reinvesting almost nothing. Now we have a problem. You know what the problem is? In 2013, Tesla had one automobile plant in Fremont. And on a really, really, really good day, it could produce about 250,000 cars. What's its production in year 15? 1.1 million cars. And if you're not setting aside money, nothing, no assembly plants are being built, no factories are being built. So I decided to call the analyst. And he was actually in an airport on his way to California. He must have been going to a Tesla shrine to worship Elon Musk in the sky or whatever he was doing. And I said, you know what, I've been looking at your equity research report in Tesla. It's very impressive, especially the pictures. But I have a question about the D.C.F. I stuck with the terminology in case he got confused. And he said, well, I can't answer those questions. And I said, why not? He said, I have a team of 6 that works on the numbers. I said, okay. He said, can I call you when your team's around? He said, I'll be back next week. You can call me and we can talk as a team. And he says, you're not going to write about this on your blog or anything, right? And I said, not for the next week. And then all bets are off. So I call him a week later. He's gathered his entire team around. And he comes on first and he says the same thing he said a week ago, which is I don't work with the numbers. And I said, what do you do? He said, I schmooze. I said, what? He said, I talk to people, I talk to analysts, I talk to management. I said, okay, you're a schmoozer. Okay. I said, what does your second in command do? He comes on and says, I'm the secondary schmoozer. I go with this guy. When he schmoozes, I schmooze too. And the third guy comes on and says, I'm the backup schmoozer. One of these guys can't go, I go. And I said, who the heck in this group does anything but schmooze? They point to this 24-year-old they hired out of Wharton 2 years ago. Say, he's the guy. He's the number cruncher, low man on the totem pole. And I feel really sorry for this kid. So he comes on and we go line and he gets it. And I said, what happened? He said, it slipped my mind. I said, what slipped your mind? He said, I was just taking each line item, projecting them out, and it slipped my mind that we need to build more assembly plants. I said, do you think it's a problem? He said, yes, of course it's a problem, but I don't see a way in which we can go public with this. We can't go to the market and say, we just slipped our mind to build assembly plants. Do you have any suggestions? I gave him one, but he never took it. I said, have you ever watched this movie, Willy Wonka's Chocolate Factory? Not the Johnny Depp stupid version, but the original one. He hadn't, he was too young, but one of the older analysts, yeah, I remember that movie. And I said, I remember seeing that movie, and I came out of the movie with one big question. If you've never seen the movie, this is a movie where Willy Wonka chocolates are in every store in the world. They're one of the biggest chocolate makers, but they're only one factory. It's a very, very inefficiently laid out factory. It's got like chocolate rivers running through it and strange looking creatures walking around. And I never quite figured, how the heck did they make all these chocolates with this inefficient factory? I was a strange younger person. Now I'm a strange older person. But the answer is actually in the movie. There are these magical creatures called Oompa Loompas. If you've never seen them, go on Google search, type in Oompa Loompas, you'll see them. They dance around. While they dance around, chocolates come flying out of the factory. It's magical. I said, here's what you need to do. Put out a press release that Tesla has fired all their Fremont workers and replaced them with Oompa Loompas. That takes care of the problem. No problem. 250,000, not a problem. The Oompa Loompas dance, more cars will come flying out. These are Oompa Loompa valuations. I don't have a problem with what you're projecting about revenues, but those cars are not going to make themselves. It's amazing how things pass for discounted cash flow. The only thing about it that's DCF about it, that's CFs and D. That's all there is. There's nothing else about this DCF that even merits the use of the word DCF. So if you want to have some real fun, pick up a sell-side equity research report. And if it has a DCF, just take a look at the story that's being told in that DCF. And ask yourself, why do they even waste their time? What's the point of doing this? Your heart's not in it. You have no idea what you're building in as a story. So Nicholas, I'm sorry, I kept going by. What was your question?
Oh, sorry. Just a question about something you were saying earlier about like VC overconfidence with respect to large markets. And I guess it was kind of a two-pronged question. The first being, do you mean that VCs are overconfident when it comes to their ability to like pick a higher rate of winners, or to more construct a portfolio that
On everything, right?
ends up having
And it's not
sufficiently
just
big
on
winners?
the VC. You know who becomes VCs of companies? It's always, remember in high school, you had these kids who walked around acting like they knew everything and owned the world. And the most unfair thing was they actually ended up becoming because the qualities that allow them to do it, you know, that when you look at CEOs, one of the qualities that ends up making you a CEO is you've been overconfident all your life. And because you're overconfident, you can tell this big story and get away with it because you actually believe your own bullshit. Venture capitalists are overconfident people to begin with. That overconfidence plays out in everything. They think they can pick winners. And once they pick winners, where they project revenues, what do they project? They project that their product, the person they picked, is going to make the product that delivers the highest revenues. When they look at margins, they say, we're going to beat the competition. Can you imagine sitting in a room with Mark Cuban projecting numbers? On every single number, I can predict he's going to say, hey, this is a business I backed, you're going to win, this is what's going to show up. So that overconfidence plays out not just in the companies they pick, but then in every subsequent valuation. So when you see a VC pricing of this company, it's going to reflect it. And because there's a selection bias, the other VCs who come to that business don't ask sensible questions. They come in because they've already chosen this business, they latch on. So it shows up in almost every dimension of what they do. And it's not a bad quality. If we did not have overconfident people out there, we would never have disruption. We'd never have startups. This is one of the costs that comes with that business model. You're going to have people who crash and burn. So it shows up in almost everything they do.
Yeah, because the second part I was going to ask is when you refer to large markets, some of it also has to do though with trying to like project a market that might not exist already, right?
Yeah, that's fine, but that's a mistake, right? If that was all you were doing is making mistakes on it, the mistake should cut in both directions.
Yeah.
Right? And that's not what happens. The mistakes, if you look at them, tend to be when you make mistakes, you almost always see the mistakes that you came in with too high a number rather than too low. So mistakes are part of uncertainty. But the kinds of mistakes you make also give me something about bias. In this case, I think the overconfidence makes them biased upwards in what they estimate for the company. Shreya?
Professor, so this is also about the oversized market question. I was sort of wondering why you decided to aggregate all the valuations of all the players, because when a company is estimating its cash flows, it doesn't really assume that everyone who starts off in this business is going to be successful.
No, but in a rational world, what should the summation work out to? If people are rational about the size of the market,
should be the
roughly
size.
speaking, what you get is a valuation of the sector should reflect the size of the market, right? My point is, because people are overconfident, you add up the valuation of all cannabis stocks, you're actually getting a value higher than the potential profits you can make from the cannabis market. It's not that any group is being irrational. They're being rational, but because they're overconfident, that rationality is paying out as numbers where you act like you're the winner and everybody. You'll notice this often when companies make plans. They say, we'll do this, this, and this. And nobody stops and asks the question, when we do this, what if our competitors do this? It's almost like nobody wants to bring that in. And that's playing out in the aggregated value being too high. So that's where the overconfidence plays out, because otherwise, if people were rational, large markets should lead to large valuations in collection. So I don't have a problem with that. It's just too large a valuation given that market size. Yossi?
Yes, Professor, regarding the sell-side research, but those who pay this research are pension fund analysts, hedge funds. Those are very wise and thoughtful investors. How come they make such a material analysis and they pay for such a material mistakes?
Do they pay for it? Sell-side research, by definition, is free.
Oh, they don't pay for it?
No.
I think they don't
pay
how
for investment banks make money,
summary,
right? It's what you do with the investment bank. Sell-side research is a freebie that a Goldman Sachs will give a client, and in return, what do they hope the client will do? That they will trade through Goldman Sachs. It's a completely free add-on, and that's part of the problem, right? It's sell. The key word is sell. So you're selling, you're basically offering this research, hoping that the clients who use that research use the investment bank's other services. So
Like
there
a
is no
marketing
sell
flyer.
side.
It's like a marketing
Right?
flyer. It's like a marketing flyer.
Yeah, it's like a market. It's a very expensive marketing flyer. It's very glossy. It looks good. And it gives portfolio managers a defense, right? If they pick a stock based on sell-side analysts and it goes down, you know what you tell them? Look, I was just following sell-side equity research. So it gives them a way of passing the buck when they make a mistake. But sell-side equity research, maybe that's the model we need to go through, where people pay for sell-side equity research based on the recommendations, because then these analysts will be held accountable because people are paying for the research. But right now, that's not the way it's structured.
Thank you.
Sarah?
Hi, following up maybe on Yossi and Nicholas's question. So a mistake has been made, valuation is too high, and you went in too high. Is there any way to rectify that, or is it just it's
The
over?
market will take care of it, because what's eventually going to happen as this business matures, artificial intelligence, electric cars, your actual revenues are going to come in, your margins are going to come in, and if you've systematically overestimated, here's what's going to happen: the revenues you get collectively will be far lower than what you were projecting in year 1 and year 2 and year 3 across the business. Doesn't mean every company is going to come in, but the collective revenue. So the market will go through an adjustment process. So I call them bar mitzvah moments, where the market says, are you grown up yet? And those moments take a long time. And when that happens, you get this correction across. So eventually the truth wins out. This is about betting on a business, and the business is not there. You and I can convince ourselves it's there, but the truth finally shines a light on it, and we all adjust to it. Jonathan?
Yes, so whenever you see a price target from like Yahoo Finance or another website, is that sell side?
That's sell side. And you know how they get the price target, right?
The same way that of your Tesla
The
story?
pricing. Basically what they do is they project earnings out. It's not based on a DCF, they project earnings out into future year. They apply a P ratio to that earnings. So that's all it is. It doesn't mean it's bad. It's a pricing target, not a value target. So let's now move to step 4. So at this point, let's see where I am. I've told a story about Uber. I've tested that story to make sure it's possible, plausible, probable. I'm now ready to convert my story into numbers. You ready? Remember the story for Uber. How did I describe them? An urban car service company. So you know what I used as my market? The total market for urban car service. Easier said than done, because in 2013, you know who dominated that market? When you think about urban car service, pre-Uber and Lyft, what are the two ways you got urban car service? Taxi cabs and these limo companies. Remember the companies that used to pull up in front of investment banks at 9 o'clock in the evening? And neither is publicly traded or corporate. So it was the most incredibly tedious job of all, is coming up with the size of the market. Here's how I did it. I actually went city by city, because the taxi and limousine regulators in each city keep tabs on how big the revenues were in the previous year, and I added up cities. The cities I could not, I based on population. And I ended up with a total market size for the urban car service market of 100 billion. Is it an estimate? Absolutely. But I built it up from the cities to show you, how dangerous Google search can be. Now, often when you don't know the size of the market, what do? You go into Google search and the size of the urban car service market. When I tried in 2013, when I first valued Uber, nothing showed up. 6 months after I did my Uber valuation, I typed into Google search, size of the urban car service market. Guess what shows up as the number 1 find? $100 billion. And my reaction was, if you guys knew how uncertain I'm about that number, you would never use that number. So I'm saying, be a little cautious about what you see showing up on Google search, because especially in these markets where nothing's happening there, you're kind of starting with a fuzzy number, 100 billion. So that takes care of the urban car service part of my story. What is the second part of my story? That they would attract new users into the business. Like whom? Like my son, my niece. You know how I showed that? That urban car service number had been growing at about 1 to 2% a year in the previous 5 years. I let it grow at 6% a year, basically allowing for the fact that this new growth is going to come from new users coming in. So I've got the new users into my story. What is my third part of my story? That they would have local networking benefits. What does that mean? In my story, Uber can take New York, Lyft can take Chicago, Didi can take Beijing. You know what this is going to play out? The market share I gave Uber was 10%, huge by car service standards in 2013, because it was completely splintered. But I stopped at 10 because in my story, it's conceivable you could have 7 or 8 or 9 different ride-sharing companies in different parts of the world, each controlling different cities. So I had to stop at 10. I couldn't give them 50, 60% market share. I did assume they could keep doing what they're doing, which is keep 20% of the fare for doing pretty much nothing. So you know how this is going to show up? If you define the 20% as their revenues that they collect, because of their cost structure, they should be able to keep most of it. So I gave them margins of 40%, like software companies, intermediary companies, high margins. And they also don't own the cars and don't hire the drivers. The way this shows up is they're going to be able to grow with very, very little reinvestment. They don't buy the cars. And the way I showed this is with a sales to cap ratio of 5. For every dollar in revenues, they get $5. I'm sorry, every dollar in capital, they get $5 in revenues. To provide some perspective, the average for that number across all US companies is about 2. For capital intense companies, it's often less than 1. Even for software companies, it's 3, 3.5. I gave them 5. Basically, I'm treating them as a very capital light business because of the way they're structured. Urban car service, attracts new users, local networking benefits. Keep doing what you're doing. Collect 20%, don't own the cars. Every part of my story is a number. And then I remembered something. In a DCF, I need a discount rate, right? I mean, how many sessions did we spend on discount rates? Too many to talk about, right? Beta, risk-free rate, risk premium. You know how much time I spent estimating a cost of capital for Uber? I think it was 3 minutes. You say, why don't you go through the beta? What beta? What risk premium? I mean, in a sense, this is a company that's a young company. It's a ride-sharing company. Here's what I did. I have the cost of capital for every publicly traded company. Every year I create a histogram. In fact, this year's histogram is on my website, the 90th percentile, the 50th, the 10th. I went to that histogram. I took the 90th percentile. The cost of capital for the 90th percentile in 2013 was 12%. I gave Uber a 12% cost of capital and I moved on. This is not even my top 10 lists of worries in this valuation. What I'm trying to say is you're valuing a young company and you're spending most of your time estimating the discount rate, you've lost the script here. The discount rate is not my primary worry. And this is a company that's still young and money losing, so I gave them a 10% chance of failure. Why only 10%? Because in a sense, they're too big to fail. You know what I mean by that, right? What did the story start with? That venture capital are investing $3 billion in this company and giving it a $17 billion pricing. You know what happens when a company like that fails? What do the VCs have to do? They have to write off the investment. What do you think WeWork is worth right now? I think it's worth 0. But SoftBank will never admit it because that means you got. So in a sense, the bigger these companies get, the more incentive there is to keep them going, because admitting that they're not worth anything is, so you'll see VCs pump more money into these companies just to keep them alive. That's why it's only 10%. That's it. I have my valuation done. Revenue growth, margin, sales to capital, cost to capital. It showed up as a valuation on June 8th of 2014. It was a Friday. I remember 3:15 in the afternoon, I post my valuation. So it looks like a spreadsheet, right? But every number in this valuation reflects a story. So if you point to a number, say, why are my revenues, no, in this case, if you look at year 10, 3.6 billion year 10, my response is because an urban car service company with local networking benefits. Why are my margins so high? It's because they keep 20% of the fare for doing nothing. Why is my reinvestment so low? Because they don't own the cars. Every number in this valuation, you ask me about the number, I'm going to respond to the story. The bottom line was I got a value of about 6 billion. It's 3:15 in the afternoon on a Friday. 15 minutes later, I get a call from a Wall Street Journal reporter. She must have been just waiting at her desk for this valuation to come out. She said, I noticed you just valued Uber. I said, thank you for noticing. She said, I also noticed you value them at about 6 billion. I said, you're very observant. She said, you do know that venture capitalists have valued the company at 17 billion. I almost corrected her then. By now, you know what I'd have come back with, right? So here, what do you think I was thinking in my head as she said, venture capitalists have valued the company at 17 billion?
Oh, they're likely very overconfident.
Or they price companies. Venture capitalists don't value companies, they price them, right? Because you price them based on users and subscribers. They want to sell. It's not because they're bad people. They make money from the pricing game. But she's a journalist, and I just had to cut her some slack. And I said, yes, I know they valued it at 17 billion. She said, how do you explain the 17 billion? I said, I don't have to. I didn't pay it. I've never felt the urge to explain what other people pay. She said, are you telling me they're wrong? And I'm saying, I'm telling you nothing of the sort. I'm saying with my story, I can't get to 17 billion. Maybe they have a much bigger story. Why don't you ask them? I don't own the story for Uber. This is my story, my valuation. It's personal. All valuations are personal. They reflect what you feel about the company's future. But you know what? My decisions have to be driven by my story, not a management story, not some equity research analyst story. I have to take ownership. So when you look at the value of a company, it's easy to think of it as a collection of numbers. In this case, it reflects my story. So I put this up and I got incredibly lucky because in step 5, what did I say? You want to keep the feedback loop open. You want to hear from people who don't hang out with you, don't think like you. And one of the reasons I like to post my evaluations on my blog is it attracts a fairly diverse audience, sometimes more diverse than I want it to be, but they come from very different points of view. And this particular post, I got particularly lucky because it got picked up in 4 different places. The first was a site called 538.com. You guys heard of 538? It's actually Nate Silver's site. It's a math and statistics geek site. Basically, they apply math and statistics to pretty much everything. So the editor of the site, emailed me and said, would you let us put this entire post with the valuation on? Because the readers of our site like this kind of stuff. I said, okay. So a whole post with the valuation goes on. The second place it got picked up was the Forbes blog. You know who reads the Forbes blog? I think 75-year-olds with flip phones. It's got a very old audience, very old time, people who kind of grew up in the 60s or 70s, believe in PE ratio, worship at Warren Buffett's altar. The third place it got picked up was a site called TechCrunch. You guys heard of TechCrunch? It's this geek. It's read by geeks, VCs, tech people. And the fourth place it picked up was a site called the Ride Sharing Guy. If you get a chance, visit it. It's still around. It's run by a guy called Harry Campbell. And it's written for Uber and Lyft drivers primarily. You say, how many of them can there be? Do you know how many people drove for Uber last year? 3 million people. So this is a pretty big audience. Same post, same valuation, 4 different places. I get 4 very different sets of feedback. On the 538.com site, here's the kind of question I get. So I noticed that you've used a 12% cost to capital based on your histogram, and you told us you used the 90th percentile. I went and looked at your histogram, and the 90th percentile is 11.97%. How come you use 12%? This is how geeks think. So the reason I leave my valuations kind of open is I said, look, why don't you try 11.97% and see what happens? 5 minutes later, I get an email back saying, now I see why you left it at 12. Nothing happened. Okay. So nothing on the 538 side alters anything because they were all asking questions about details, the second decimal point. On the Forbes blog, they loved it. They patted me on the back saying, this is what those founders should be doing. I didn't even waste my time on this side. All I'm going to hear is people patting in the back saying, this is. Then I went to the TechCrunch site and those guys absolutely hated it. Their response was, how dare you value one of ours with your DCF models? We don't do that in Silicon Valley. This wave of insults. But you know what? I read through the insults. So there's nothing learned. Now I think one called me, You New Yorker. That was the entire insult. I didn't even know why it was an insult. You New York. I'm not even a New Yorker. Why that's an insult, I don't know. You finance guy. That's supposed to be an insult. You DCF guy. You theorist, etc. But then you got to the richer insults. And insults are, you idiot. Let me tell you a little bit about how the ride-sharing business. And they told me about the technology of ride-sharing, how they collected information, and I learned things about the ride-sharing business I would never have learned if I'd stopped at the insult. I'm not a tech person. I don't know how Uber knows what locale you're calling from and adjusts the surge pricing. I learned things about the insides of this business I wouldn't have learned. And then I got to the ride-sharing guy, and I learned some very interesting things about Uber I would never have learned if I'd visited the company and talked to the management. I heard from an Uber driver in LA, and he said, I looked at your valuation. I really don't understand valuation that much, but I noticed you assumed that Uber kept 20% of the fare, and that was their revenue. But that's really not true, he said. He said, here's what's happening in LA. I used to drive for Lyft until 2 months ago. Uber paid me $2,500 to switch. Now, Lyft is offering me $4,000 to switch back. I feel like a free agent without a contract. I could play these guys off. And my guess is by the time they finish paying me, I'd be surprised if they kept more than 7 or 8% of the fare. 4 years later, Uber admitted that their contribution margin in the big cities, which was 7 to 8%. I almost wrote to them saying, I knew this 4 years ago when I talked to your Uber drivers in LA. You know what? In 40 years of valuation, I've never once ever visited a management team, never called a CEO about a company. I think it's the worst place to go to get information. If you want to value a company, go park your car in their parking lot, get past the security, talk to the janitor. You will learn more about the company talking to people in the mailroom and the trenches than you will. You will learn more about a retailer by going into a store and talking to their salespeople and their management about how the company is run. And then for me, the whole thing came to fruition. This feedback loop came to fruition it was, I think, about 2 months, not even that, 6 weeks after I valued Uber. I was in Munich airport waiting for a connecting flight. And my connecting flight was delayed, and I decided I should do something productive. And I checked my phone for emails, and I see an email from a guy called Bill Gurley. For those of you who've never heard of Bill, he's a venture capitalist. He's part of Benchmark Capital, one of the leading, he's actually one of the deepest thinkers in the VC business. He's the one pushing for direct listings. But in this particular story, there's particular resonance because Benchmark Capital was one of the earliest investors in Uber. They invest in Uber when it's a $1 billion company. And in 2013, Bill Gurley was one of the directors, the board of directors of Uber, and was rumored to be the person closest to Travis Kalanick, who was the CEO of Uber. So let me ask you a very simple question. Do you think Bill Gurley knows more about Uber than I do? Of course, right? So I open up his email. And here's how it begins. I read your blog post on Uber, and I did not like it. So, okay, we got that out of the way. He says, I've written my own blog post to counter your blog post. This is blog post to blog post warfare, very high tech. And I've said some terrible things about you, and I just wanted to let you know. Sincerely, Bill. I'm still in Munich airport. I still am an hour before my flight. Guess where I went next? I went to Bill Gurley's blog. It's called Above the Crowd. He's 6'6", so above the crowd, you kind of get it. And here's how the lead post says. Damodaran misses by a mile. Get it, Uber driving, misses. And basically, he took issue with every part of my story. He said, Uber is not a car service company. It's a logistics company. Notice how words have consequences. What's he done by using the word logistics? He's expanded his business to be not just car service. It could be delivery. It could be, it could be any of the. He also said, Uber's not just urban. It's going to be everywhere. He gave examples of suburban and rural versions of Uber services would catch on. And finally, he said, you know what, I understand this networking, but we're working on making local networking benefits to global benefits. By doing what? By connecting with the credit cards and the airlines, we're going to take our dominance in New York City and make it dominance in Bangkok. So the way it will work is if you're flying from New York to Jakarta on United, as you make your reservation, Uber would be a partner, and after you make your reservation, they would offer you an option. Do you want an Uber car waiting for you when you land in Jakarta? And I read it and I was fascinated. Along the way, it took multiple swipes at me, which I didn't care about. So basically, I let it go. And then I finished the story. It's still 50 minutes to my flight. I emailed Bill back and said, I just read your blog post. It's fascinating. Do you want me to put a number on your story? He said, what are you talking about? I said, you've told a really big story about Uber. I can convert to a number. He said, be my guest. I said, okay. I opened up my Excel spreadsheet, still sitting in Munich airport, and I changed 3 numbers, actually just 2 numbers. First, remember I'd used a $100 billion market because it was an urban car service company. I replaced it with a market 3 times larger, because that's what happens when you go from car service to logistics, much bigger market. I took the 10% market share, local networking benefits, and because when you get a global networking benefit, there are going to be only 3 companies or 2 companies dominating this business. I gave them a 40% market share. See the value that I get for the company? 53 billion. So I sent this to Bill. He said, do you like this more? He said, a lot. And then he said, oh, you know what? By the way, this 20% share, I don't think it's going to be around for long. I think we'll be lucky to end up with about 10%. I almost told him, I knew that already. I talked to the Uber driver in LA. I said, okay, that's easy to fix. I take that because it's an input into my value. I said, if you get a 10% share instead of 20% share, your value becomes 29 billion. You can say, how can the same company be worth 6 billion, 28 billion, or 53 billion? It depends on how the story is framed. I'm not saying they're all right values. One of these is going to be closer to the truth. In fact, at the end of 2014, and it's still on my blog and you can check this out, have you ever been to a Build-A-Bear store in a mall? These are freaky little places. Basically, you take your 8-year-old in and they give them this piece of skin to stuff. 30 minutes later, you got the ugliest bear ever made, but your 8-year-old made it. And then they pull this really dirty trick on you, the store does. They come to you and say, you don't have to buy this bear. But if you do buy this bear, it'll cost you $75. I guarantee you're leaving that store with a $75 ugly bear because your 8-year-old. So I drew on that concept and said, why? Because people kept saying, I don't like your story. I would have done this. And I said, you know what? This is my story. You want to make it your story? I'll give you the tools. So I created this post where I let people pick their own story for Uber. Is it a car service company? Is it a transportation company? Is it a logistics company? Or is it an on-demand company? You know what an on-demand company is? You want something in a hurry, an on-demand company will get it to you. The closest thing I've seen to an on-demand company is this company called GoCheck. It's an Indonesian company. So it does all the things that Uber does, right? You can move. It also does things like, let's say you get home, you forgot to pick up your pills at the pharmacy. GoCheck will pick it up for you. An Avengers movie is coming out next week. You don't want to stand in line because you don't have 3 hours to stand in line. GoCheck will send somebody to stand in line for you. So it's an on-demand company. You have something, they will replace your time with somebody whose time is less expensive, I guess. I said, does it have global networking benefits, local networking benefits? What are its competitive advantages? So basically at each stage, rather than my picking my story, I said, you pick the story. In the end, I gave them the range on value depending on the story they picked. And guess what? Depending on your story, you can tell me Uber's worth nothing or Uber's worth nothing. And I remember posting this and people said, this is why I don't do DCF. I can get any number I want. I said, you're missing the point. That's not what I'm saying. I'm just saying the value you get out of a DCF reflects the story. Not all stories are equally plausible. Your judgment is my story going to be closer to what actually unfolds? And one final point, and this is something we started the class with, your story is not forever. It's going to change. In fact, 3 things can happen to your stories. The first is your story can break. What can cause your story to break? I'll give you a very simplistic example. You're a young pharmaceutical company with a very promising drug. working its way through the pipeline. It's in stage 3. You've attested $10 billion value to it. What could cause that story to break? All you need is one story, one basic story reflecting something that happened. It's in stage 3, so it's still in testing, right? The next day, you open up the journal and it says, 2 people in that last stage developed serious symptoms, and the FDA has asked the company to pull the drug. Your story is broken. Yeah. A story break can happen, especially with young companies, single product working its way through. Your story can shift, which means your story stays the same, but the contours shift. I've told pretty much the same story for Apple for the last decade. I've called them the greatest cash machine in history, but really a smartphone company with a lot of side stuff. And that story shifts, right? The Apple services business does a little better. So the story is shifting, a little higher growth, a little lower margin. So the basic contours stay the same. Well, your story can change because you're doing something I didn't think you could do. My Peloton story in 2021 is very different from the Peloton story I told in 2019. In 2019, I described them as a luxury fitness equipment company with a premium subscription model. Very narrow. But with COVID, what happened was you had millions of people try that $13 a month subscription, and a lot of them liked it. So I think today when you value Peloton, it's really a subscription company that happens to sell fitness equipment on the side. The stories can change. And to me, that is the essence of COVID, is it's changed so many companies' stories. Think of the story for Zoom. In February 2020, I valued it in this class, in the valuation class, or the valuations of the week. It's actually on my valuation of the week from last year. And I valued it as an online business meeting company. The problem is online business meetings, collectively, globally, the total market was 20 billion. Today, when you value Zoom, I'll wager your total market is way above 20 billion, not just because businesses are going to use the online meeting, and it's well beyond COVID. I'm not just talking about COVID, no. But you're going to have, you have educational institutions using Zoom. You have people who actually have, Zoom get-togethers, Zoom, thank God it's Fridays. This might, it's a depressing thought, but this might become part of your family get-togethers. We had Zoom get-togethers all through this break, which will probably last well beyond COVID. Stories can break, stories can change, stories can shift. I hope none of your stories breaks before May 10th, if you're valuing companies, because that is a pretty catastrophic occurrence, but it can happen. It can happen, especially if you have a disaster at your company, something that undercuts the basis of your story. Any questions about storytelling and number crunching? So here you have a question? No? Oh, Ankit, go ahead. I can't hear you, sorry. Is your mic on? Let's see, my headphones are dead.
Professor, we couldn't hear either. So it might just be that person.
Sorry, Ankit, go ahead. Okay. Oh, none of us can hear you, so maybe it's your side. I thought it was my side, but no.
Sorry.
Okay, go ahead now. We can hear you now.
Oh, sorry. So what I was asking is, when you did this in 2014, did you consider the local regulations because Uber lost entry in Germany and China? So did you take
that's always been in the background with Uber, right? That cities, that's a losing battle for cities. It's a losing battle. All you can do is add a little bit to the cost structure. The reason it's a losing battle is taxi cabs are done. That business is over. We can wish it were true, not true, but that business is over. Ride sharing is essentially going to be, so you can add more restrictions on ride sharing, but we're all too used to the convenience, right? In fact, the best story I can think of is about 4 years ago, or maybe longer than 5 years ago, New York City wanted to put these restrictions on Uber in the city. This is, they wanted to restrict, parts of the city because, and they framed it in terms of we want less traffic, but really they wanted to save the taxi cab business. And normally in New York City, the council actually passed, so it was passing through the council, the mayor wanted it. And New York City, once the council and the mayor want it, it's pretty much, it's pretty much a done deal. And Uber mounted a counter assault. You know what they did? So I think 2016, you were trying to call an Uber. You basically know how when you call an Uber, it offers you choices, black car, Uber X. And in 2016, they added an option called Uber de Blasio. And you hit that, they said, well, there's not a car within 31. They basically calculated what would happen if the restrictions were passed, and your wait will be 1 hour and 23 minutes. So basically, they got people essentially riled up by saying, if this passes, you're going to be waiting 1 hour and 23 minutes for your Uber. And it's the first time I've ever seen this happen in New York City. The outburst from people who are Uber users to the council and the mayor was so much that the entire thing was pulled off because people were afraid of the backlash. This genie is out of the bottle. Europe will always be the last stand, right? Because Europeans are, now I remember I was in Zurich once and Ubers are restricted. I'm in an Uber. Why am I in an Uber? Because it means I don't have to convert into a foreign exchange. I don't have to carry Swiss francs in my pocket. And this Zurich cab, so we're driving down the street, Zurich cab pulls up right in front and just brakes right in front of the Uber. And the taxi cab driver comes out and bangs on the Uber window, the driver's window. And then he just gets into his car. And I said, what was that all about? And he said that taxi drivers don't like us very much. So we go through this process. But I think this is what happens when your business becomes a dinosaur. And the taxi cab business, and let's face it, the regulators contributed a great deal to making them a bad business, is done. So this is built into their business model. In 2021, it's not just that, the bigger challenge is not the regulations. It's what Uber is increasingly being asked to do in many countries, which is, I think in the UK yesterday, didn't they announce that all Uber drivers were going to be treated as employees? So what it effectively means is your cost structure just changed, right? Your margins are going to be low. You now have to pay, whatever social security taxes are. Your lawsuits will be against the company, because up till now, Uber's defense in a lawsuit was independent contractors driving their own car, don't blame us. And increasingly, those things are going to get, and that's fair. I think it's, this delusion that Uber is full of independent contractors who operate on their own terms is absurd. So eventually, I think Uber drivers will become not full employees, but at least quasi-employees with many of the protections. And so when you value Uber, that's got to be built into the cost structure. The restrictions themselves will come and go. There are ways in which cities negotiate to get a better deal from Uber and how Uber treats employees locally, but they're not going to stop it. That's done. That can't do it anymore. Yeah.
Got it. Thank you.
So now we're going to, if you notice, how many sessions are we through this class? 12, 13 sessions? I haven't valued a single company yet. This is a valuation class. You're saying, when are we going to get to valuing an entire company? I've done pieces. Revenue for a company, cost of capital. So that's going to change over the next, the rest of this session, the remaining 10 minutes and spilling into the next couple of sessions. All I'm going to do is value companies, but I'm going to do them in high speed, and each one I'm going to focus on a specific variable, because otherwise you're going to get bored out of your wits, because I'm going to go through the same process over and over again. So let me set the table. You're going to see valuations ranging from 1999, maybe even earlier, all the way through 2020, maybe even 2021. And you're going to see equity risk premiums in each of these. You say, where did they come from? They all reflect what I was using at that point in time. So I'm not gone back and fixed these numbers. The pre-1998 valuations, you'll see a 5.5% premium, almost stuck in stone. You know why? Because I used to use historical premiums. Historical premiums didn't change, it's very static. Between 1998 and September 2008, you're going to see about a 4% premium. That was my implied premium, and the numbers kind of moved around 4%. Starting in 2008, you're going to see my equity risk premiums reflect not just the year in which I do the valuation, but the month. You know what I mean by the month, right? You remember what happened to equity risk premiums in 2020. They went from 4.7% on February 14th to 7.8% in March of 2020, now over a 6-week period. If I value a company in March, you're going to see a 7.8% premium. Why? Because I have to value the company in the market it's in, so you're going to see these premiums shift, and for the most part, they're implied premiums. So now let me start with what I'm going to do for each company. For each company, I'm going to tell you my story for the company. And then I'm going to show you the valuation that comes from that story, but I'm going to focus on a part of the valuation that I think makes the most difference in that company. So let's start easy. Let's put our training wheels on before we get all acrobatic and try to do things we shouldn't be doing. I'm going to start by valuing stocks that look very much like bonds, companies that pay big dividends and have low growth. Okay. In fact, the company I'm going to use to illustrate this is Con Ed. For those of you familiar with Con Ed, it's a regulated utility. What is it that makes regulated utilities in the US different? They tend to operate with monopolies or quasi-monopolies. You think this is great. But that quasi-monopoly comes with a catch, which is many of these regulated utilities, the pricing is out of their hands. So when Con Ed tries to set the price for power, it can't set the price at whatever it wants. It's go in front of a regulatory commission. And the regulatory commission tries to allow them a price increase commensurate with what they need to make in terms of cost of equity. So it's a low growth monopoly. So this is a company that fits all the requirements for a mature firm. It's paying dividends like a mature firm. It's paying out almost 73% of its earnings as dividends. Its growth rate is 2.1%, which is less than the risk-free rate, again, a requirement for a mature firm. And finally, if you look at its risk, the beta is close to 1, the cost of equity is low. So when you look at the payout ratio, the growth rate, and the risk, it looks like a mature company. The reason I say that is some of your companies will have low growth. That's only one of the 3 conditions. Check to make sure the rest of the characteristics meet it. So this is a big mature company that pays out pretty much what it should pay out as dividends. So you know what I did to value it? I used the stable growth dividend discount model. It's called the Gordon growth model. It's a model that's been around 70 years. And I took the expected dividends next year. So 232 is the dividends in the most recent 12 months, grow it at 2.1%. That's dividends next year. And I divided by the cost of equity. And I used all the traditional things, risk-free rate, beta, and a bottom-up beta, and a risk premium, 7.7% cost of equity. Risk expected dividend divided by cost of equity minus the growth rate gives me a value per share of 42.30. Can't get any simpler than this. 3 numbers, expected dividends, cost of equity, growth rate. The stock was trading at 40.76. To the extent that I believe this valuation, it looks like the stock is slightly, very slightly undervalued. Now, one of the things that you can always do once you've done your valuation is rather than just go with that value, you can ask a different question, which is, hey, what if my growth were different, right? Well, you made an assumption about 2.1% growth. What would happen if I used a 2.2% or a 2.3%? In fact, that's what I did in this graph is I kept everything else fixed and changed the growth rate. What was I trying to find? What would the growth rate need to be for the value per share to be equal to the stock price? It's actually something you can do with my spreadsheets. Play with the growth rate till the 2 converge. There's a book called Expectations Investing. It's written by 2 very good friends of mine, among the best people in valuation, Mike Mabusson, who teaches Columbia, but he's also, he's had a long and illustrious career on Wall Street. And Al Rappaport used to teach at Northwestern. He's now semi-retired, but basically writes a lot on valuation. And the book is all about backing out from the price what the market is expecting. And that's basically what I'm doing. You're saying, how does this help me? The break-even growth rate is about 2.1, 2.0. I mean, basically, if the growth rate was slightly lower than the 2.1% that I estimated, then clearly the undervaluation goes away. So it's another way of framing, do I want to buy the stock? Am I so certain about the growth rate that and my answer is not really. This is so close to what my growth rate assumption is that I'm going to let it go. What would be different if I'm assuming a 20% growth rate and the market is assuming a 60% growth rate? Then I'm going to act because the difference is large enough. Okay? So when you think about DCFs, that's something to factor in, is embedded in the price is assumptions about the future. You can back out those assumptions. So now let's kind of fill in the middle. So let's assume that you believe that your valuation of Con Ed of 4230 is a fair estimate of value. 7.7% is a fair cost of equity, and that your expected dividends next year will be the $2.32, growing at 2.1%. So you got the value, you got your 7.7% cost of equity, and you got the expected dividend. Can I use those numbers to get a target stock price a year from now? So if I were to believe that value, what will the value per share be a year from now? Manav, do you want to help me out here? What would I do to get the expected price a year from now? Let me get you started. Value today is 4230. What's the essence of fair value? When I say that something is fairly valued, what am I telling you you're going to make as a rate of return if you buy at that value? You're going to make your cost of equity, right? At 7.7%. So you could take the 4230 and grow it at 7.7%. And that's going to give you how much money you will need Con Ed to give you at the end of the year. But there's one adjustment, right? Some of that 7.7% comes from price appreciation. Some of it comes from dividends. If I subtract out the expected dividend, which is 232 grown out at 2.1%, that's going to give me my expected price a year from now. Hold on to this technique, because many of you might end up working in places where somebody will ask you, what's your target price 5 years from now? Value per share. When you do DCF, you get a value today. But they say, hey, convert this into a target price 5 years from now. Here's all you need to do. Take your cost of equity, which you should have estimated yourself. Take your expected dividends. The difference is price appreciation. Use that to get expected target prices. I think the number you actually get if you use the 7.7% and the dividends is, I don't know the exact number, it's like $44, somewhere around that, 43 something. If you bought the stock today, which is the current price, 40.76, you're going to end up making well above 7.7%. That's the essence of undervaluation, right? You're buying a stock and earning more than you need to make. And that's what the DCF is backing into. Any questions? So basically I used a stable growth dividend discount model, and I'm using it to answer all kinds of questions you might have about what will be the price a year from now, what's my expected return. You know, get used to using those levers, because it'll make your value a little richer. I'll close today with two valuations, and these valuations actually are on either side of the 2008 crisis. So the first was a valuation of 3M that I did on September 12th of 2008. I call that my last day of innocence, because that was the day that the 2008 crisis kind of kicked in, that Lehman went bankrupt over the following weekend. So the first valuation is on September 12th. The second valuation is going to be a month later. No new information came out about the company. And I want to talk about why crises can change values. The company I'm going to value is 3M. You know what 3M does, right? Incredibly boring things that make a lot of money. Like that Post-it note. The person who invented that should probably get a Nobel Prize. I mean, think of how many Post-it notes you put all over the house. So it's actually a very simple company, a very profitable company at the time. And in September 12th, I reflected that. I gave them a 25% return on capital, reflecting their history. They'd earned a high return on capital, huge margins, and they didn't reinvest much. They were a pretty stable company, 30% reinvestment rate, 7.5% growth rate. So I'm giving them 7.5% growth, high return on capital. And with that story embedded of a continuing success story, the fact is the value that I get today is about $83.55. Just a traditional DCF with an so when you value a high margin brand name company, this is not surprising. You see that reflecting the return on capital, the growth rate. Yeah. Stock was trading at 70. So, every company that I value, the question you should always ask me, well, what did you do? Because I couldn't say I did nothing, in which case I wanted to value the company, but it was Friday, it was late, and I said, I'll do it on Monday. Thank God I waited. Because on Monday, of course, the crisis kicked in. And I ended up not buying 3M right then. I ended up buying it about 2.5 months later. But here's what happened, the crisis. The whole world came apart. So on October 16, this is a month and 4 days after my first valuation, I revisited 3M, and none of the numbers for the company had changed. There were no new earnings report had come out. but my value went from 83 to $61. You're saying, what happened? Well, my risk premium, which I'd been using a 4% premium, jumped to 6%. Why? Because the crisis pushed up the risk premium. So I had a higher cost of equity and a higher cost of capital. I did bring in the effect of the crisis. I saw it slowing the economy down into a lower return on capital. So a lower return on capital, lower growth rate, higher cost of capital. The value per share that I got was $60.53. You're saying that's a big change? Remember, markets also reflected the change. They were down, the stock was down to 57. 3M got as low, I think, as $46 per share. I ended up buying it towards the middle of November of 2008. My point is, don't worry about the fact that your value changes. In fact, it should change a lot during a crisis. Remember, the price is also changing, and this is about looking at the difference. So on Monday, when we start, we're going to delve into valuing the market first, and then we'll look at valuing difficult to value companies. So I'm going to end with that, and I will see you on Monday.
Thank you, Professor.
You're welcome. Take care.
Professor, if you have a minute, can I ask a question?
Sure. Yeah.
Okay. If I'm an investor and I've heard that the discount rate is my opportunity cost,
You sound skeptical about both dimensions. You are an investor.
Yes, and the discount rate is
you
supposed
have
to
a
be
required return. Yeah.
the discount rate is supposed to be the opportunity cost, but for me that won't really be the cost of capital, correct? That will be the cost of my next best use, the next best return I can get.
On an investment, what's the added? What's a qualifier you always have to add? On an investment of equivalent risk, right? That's why we don't have one cost of equity for every company. It varies across companies. That's right. It's what you can make on an investment of equivalent risk. So it's going to vary. The question is, how do I come up with that? The risk-free rate is out of your control. You can't change that. You can tell me that you'd like to have a higher risk-free rate, but it is what it is. It's 1.6%. Your equity risk premium is the price of risk in the market. You might not like it, but if you don't like it, you should invest in equities in the first place. So the equity risk premium is out of your control. The only number that'll reflect your risk is your beta. So the reality is that right now, given the risk-free rate and the equity risk premium, your opportunity costs, or what you can make on other investments of equivalent risk, are in the low single digits.
Got it. And if it's an equivalent risk, they'll all be a similar-ish return. Betas, should be the cost.
Right? Beta. So basically, that's where it shows up. So that if you invest in a riskier market, maybe in an emerging market, you have a higher, but it's because your equity risk premium is going to be higher. My point is, it's in there. None of these numbers are theoretical numbers. I'm not saying this is what you should make. I'm saying this is the price of risk. You can take it or leave it, but you can't make up your numbers. That's why if you told me, look, I'd like to make a 10% return, my response is, yeah, I'd like to fly. I'd like to lose weight and eat 5,000 calories a day. But you can't do that, right? You essentially have to live in the world you're in. And that's why the cost of equity has the resonance. And that's why I spend so much time doing the implied equity risk premium today, because it reflects the market I'm in.
Got it. Thank you very much.
Okay.
Thanks.